right, hello and welcome to the CEMS webinar series. My name is Melissa Morley-Weaver and I'm the alumni coordinator here at the Global Office. So I'm happy to have you with us today. All right, so we have lovely Axel. He's a fellow CEMS alumnus and he is from, I believe, 1999. He studied business admin at Cologne, ESADE and HEC, and he has joined Schneider Electric as head of M&A in 2018 after 19 years, and also worked at JPMorgan and Barclays. So he's currently living in London, so he's an hour ahead of us with his wife and his lovely 3 children. So he will give you some insights on corporate venture capital today, and the floor is yours, Axel.
Yeah, thank you, Melissa. Thank you for the introduction. Hi to all of you on the phone. By the way, I don't know about the lovely children, but thank you for saying this. Hi to all of you, and thank you for joining the webinar. Just 2 points before we get started. The first one is a little bit on a personal note. You know, the slide that you're looking at says that I'm a CEMS alumni, and that's right. It doesn't tell the full story, which is that you know, CEMS has had a significant impact on my life more broadly, in that not only did I get to go abroad and study abroad and benefit from all the fantastic things that CEMS has to offer as per the program, but I also met my wife while studying at ESADE on CEMS Exchange now almost 25 years ago. And you know, if that wasn't enough, my first job with JPMorgan was actually, I landed that through the CEMS Career Forum, because JPMorgan was a CEMS corporate partner at the time. So I feel like CEMS has had a significant impact on my professional and personal lives, and I feel I owe CEMS as an idea and obviously institutions and people behind it. The second point I wanted to make is and that's related to the topic of this webinar. I run the, as Melissa said, I run the M&A group at Schneider, not the corporate venture activities, which is, you know, separate in our organization. But I still agreed to do this webinar when I was asked, A, because I find it hard to say no to CEMS, as I just said, but also because Schneider Electric, my employer, has just launched earlier this year a new corporate venture initiative, or relaunched it, if you will. And although I'm not day-to-day involved in that, I do spend a fair amount of time with the people running that. And so have some insight there. But that's just to say, if you're working in a VC fund today, or in the startup world, or if you're doing a postgraduate degree in corporate venturing, then you might find that you won't learn anything new today. But hopefully for everybody else that has less knowledge of the topic, it will at least be somewhat interesting. But the topics I wanted to cover are, give a bit of a perspective on the corporate venture capital market, look at why corporates play in this market, why do they set up these programs, and what are the issues and challenges they face when they do. And related to that, obviously, you know, what are the key success factors, i.e. how do you avoid some of these challenges? And then lastly, to give you a little bit of insight into SE Ventures, which is our, you know, the Schneider Electric corporate venture program that has just been launched, as I said. So with that said, to start perhaps just a simple definition. This is clearly not scientific here, but sort of what is this really, right? And most of you on the phone probably have some sort of idea. Some of you may have a very good idea, but you know, corporate venture capital or corporate venturing is a form of venture capital where corporate funds are directly invested in external private companies. And this is the one I've chosen here. So directly invested means not through venture funds, i.e. other VC investors, but direct investment. It can be alongside those investors, but still direct investment by corporate. And the key characteristics, I've picked 3 here. You know, they're typically minority investments. They typically target companies at relatively early stages of their development. And in contrast to the traditional venture capital world, the objectives that the corporate has in pursuing these initiatives are primarily strategic. They obviously also want to make money, or ideally not lose money, but primarily the objectives are strategic. So, you know, all of that is straightforward. I guess it's helpful to delineate that against what it is not, right? So it's not traditional VC where there's a separate fund investing institutional investors' money for financial return, not so much strategic objectives. It's not corporate M&A, which is what I do day to day, which is, buying typically more mature companies and normally buying, 100% or buying, control at least. And it's not private equity in the sense that, these companies are early stage and therefore don't have the cash flows yet that you could lever in a typical private equity structure. So, sort of straightforward, but I still wanted to put that up front to at least sort of focus what I wanted to talk about here today. The snapshot of the market. So I'm sure there's lots of data out there, and I saw data from a few different sources. I picked data from CB Insights here. The data I saw, I think, all paint the same picture, although the numbers are different. And the main topic here is what you see on the big chart on the left, that there's been substantial growth in corporate venture investing activity. So you see the bars are the dollar billion amounts invested per year globally by corporates in corporate venture investments, and the blue line is the number of investments against the right y-axis. And so you can see that there's been significant growth over the last 5 years, from $10 to $12 billion invested to around 50. And in the number of deals as well, that has doubled roughly, I guess, if I eyeball the figures. So significant growth. That's a usual pattern, I guess. So it's not unusual in rising markets and relatively good economic times. So if you drew that chart back or pulled it back to the left longer in time, back to the 1990s, you'd see that there's a significant degree of cyclicality in the corporate venture activity. And not surprisingly, usually when times are good, people tend to start these programs or commit more money to them or invest more. And when times are bad, people cut back, and we'll come back to that. But certainly over the last 5 years, we've seen significant growth. And you can also see on the top right that the share of corporate venture investment as a percentage of overall venture investment has risen, not dramatically, but from 15, 16% to close to a quarter. So obviously still traditional VC dominates that, but it's nevertheless a significant increase, which highlights that corporates this is not a fringe phenomenon, right? Corporates are sizable players in venture capital funding. And then the last bit here on the bottom right, you would expect that directionally, but it's still striking to see that Asia has pretty much caught up with North America. This is just corporate venture investing again, at around 40% of the total globally. That share of Asia 5-6 years ago was, I think, half that number. It was below 20. So significant increase there. And Europe is well behind. I guess the same is true for the overall VC market. So just some basic data, but I think it highlights that this is significant and it's been growing. And I would expect it to continue to grow, obviously, with some cyclical ups and downs.
I do have 2 questions from the Slido. So the first one is, if the CVC focus is not on financial return, but more strategic values, how can we capture or measure the impact of the investment?
Yeah, great question. So first of all, the not is, it is obviously also for financial return. It's not primarily for financial return, but also for financial return, right? Companies, certainly corporates don't want to lose money, and ideally they want to make some money. But I think the core of the question is, how do you measure it? And that's very challenging. And I don't have a good answer for you. I have, as in, a complete framework or something like that. I have perhaps some pointers in what we're doing at Schneider that I can come to a little bit later on. But I think it's one of the very difficult challenges here, that even in situations where perhaps there isn't the great financial return, there may be other benefits. And how do you measure those benefits? All right, so I'll come back to that a little bit, but it's not going to be a complete or comprehensive answer that I'll have.
Okay, and then we also have another question. How can we evaluate if this early stage company is worth investing? What criteria are used for making the decision, and how much should we invest?
Yeah, so those questions are right, that they're not particular to corporate venture investing, but are the questions that any venture investor faces, right? And those are, so I haven't included this here in the presentation. I can send you some follow-up. There are a number of frameworks that people use. I think what's I think most interesting about these frameworks is, what would you look at, right? You would look at the size of the market, the technology, the team, the competition as anybody else. So it's sort of right anywhere between 5 and 10 key factors. What's most important to understand, I think, is that if you were to link those factors mathematically for the sake of argument, then you're talking about a product here, right? So you multiply them with each other. And if any of them is low or zero even, then the whole thing is unlikely to fly, right? So what you need is, you need to have positive answers to all those factors, right? Is it a big enough market? Is the underlying technology strong? Is it disruptive? Is the team experienced? Does it have the right mix of people, et cetera, et cetera? All of these need to fall into place. Usually, I mean, it's a model, but directionally, I think it's right. All of these have to be in place, perhaps to varying degrees, but still all of them have to have some sort of tick behind them in order for an investment to be promising, and therefore for a venture investor to consider them.
Okay, great. We have another question already. CVCs are popping up all over the place, bringing along capital. Do you see valuation bubbles in the energy startup market? And when will the market collapse?
That's the famous crystal ball, right? So valuation bubble, definitely, right? Now, I would argue that that's not limited to CVC valuations or VC valuations or valuations in energy technology, right? You have arguably valuation bubbles in most mainstream asset classes, including equities in the developed world, in government bonds, so in lots of places. So I think the answer is yes, but it's not limited to this market. When will it burst? Typically, bursting is perhaps a strong word, but it deflating or subsiding, I think, will happen when you see a broader pullback in equity markets, i.e., in listed company valuations, and that typically tends to happen when there are signs of the economy turning, right? And I think we've had some of that in certain sectors over the last 3 to 6 months, and have hence seen some volatility in equity markets, but we certainly haven't seen a broad pullback yet. And I think until that happens, I don't know that we'll see, that those valuations really, come back in a meaningful way. But that's my view. Certainly, anybody who invests, whether that's in a venture capacity or more mature companies, then you're looking around, you're looking at company valuations, and you're scratching your head. Right? So it's not limited to this to this segment only, but it's certainly there as well.
Okay, question number 4 is, to what extent does CVC also engage in syndicated investments with other organizations? Why isn't this happening as much as in the normal VC world?
Yeah, so I guess by syndicate, I'll sort of interpret what I think the question is about. By syndicate, you mean where typically syndication means one or several parties make a bigger commitment and then split it into various pieces and sort of sell it on, right? So that would be a syndicated loan, and you sometimes have that with equity investment. You have it on the private equity side, where if it's large transactions, private equity firms will go to their limited partners and offer direct equity tickets in the transaction to them. So if that's what the question is, and why that isn't happening in the corporate venture world, then I would think that, if you think of why people might syndicate capital that they've underwritten, so to say, typically you do that for risk mitigation, right? So you cut the size of your check. And then sometimes you do it because you want to bring somebody in who's got additional expertise, right? So you do it for I guess, expertise and experience and or capability. The first of these two, i.e., reducing the risk, I think is less of a consideration for corporate venture capital, right? Because the ticket size relative to the size of the corporate balance sheet is usually very small, right? Now, you can still get corporate venture initiatives wrong, and a lot of them do, because you make a number of bad investments, but it's usually not one bad investment that would cause a big headache, right? So from a risk mitigation point of view, you don't have the need to syndicate. Could you benefit from syndicating it to another corporate that brings a different skill set? I think on paper, yes. Typically, I think what you then see happening is that it's not technically syndicated, but just somebody else comes in alongside you, right? And that happens, I think, fairly frequently, where you have a number of traditional VCs participating in a financing round, and then one or several corporates. So that's not technically syndicated, but it does mean investing alongside other people, including alongside other corporate venture players.
Okay, great. Maybe we should just continue with the presentation for now and hold off for questions. Okay, thank you.
Happy to. Okay, so who are the players in corporate venture capital? I've just shown some logos here on the page, as you can see. By the way, it looks like the CEMS Alumni Association is part of this landscape, but this is just the page logo. What I would highlight here is that it's not just corporates, or at least today, it's not just corporates from industries that have, that we associate with continuous significant innovation or technological disruption, right? And so those would be tech, software, pharma/biotech, etc. So those, the Google Ventures, the Intel Capitals, the logos you see on the left of the page here, and at the top in the middle are sectors or market where it sort of makes sense intuitively, right? There sectors where there's a lot of innovation, potentially disruptive innovation, things move fast, and so corporates have set up these funds often many years ago. So that's still there, but today you have a much broader landscape. So you also have corporates from sectors that you would not perhaps traditionally associate with very fast pace of innovation, right? Take Shell Ventures, take Citi and financial services, Bertelsmann and media. They're just examples. There are many more. So you have a much broader range of corporates today, and then you have a big Asian group of investors that don't sort of neatly fit into a category, but typically they are subgroups of large conglomerates, right? And Fosun is a good example. Mitsubishi, UFJ, another one, Legend. So today you have a much broader landscape than you would have had, I think, 20 years ago or so, where the traditional technology players, including in areas like biotech or pharma, would have dominated that landscape. Now, why do corporates do this? It's not, and we've talked about this, it's not primarily financial return driven, but usually some strategic objective that's central to this. Usually that's tied to innovation, and that's the key difference, I guess, to traditional venture capital investing. Large corporates are often poor at innovation, and when I say that, I guess a bit of a provocative statement to all the capable people that work in R&D and product development in large companies. When I say poor, I don't mean that they don't innovate. They certainly produce lots of new technology, new products, sometimes new business models, etc. But usually it's slow, which is inherent to big companies, right? There's processes, there are controls, there's bureaucracy, not just to their R&D efforts, but to anything they do. Usually it's expensive, and expensive in the sense that the output per dollar or euro spent, in terms of how much innovation do you produce for euro or dollar spent in R&D is often not good. And when it does produce innovation, it's typically rather incremental than disruptive, right? And there's a lot of good reasons. There's a lot of research on that as to why it is easier to disrupt if you're on the outside as opposed to sort of on the inside and have something else to defend, right? So in that sense, the thesis here that I'm making is that large corporates are not great at innovation, and hence venture investing, because of the reality that smaller, nimbler companies are better at this, venture investing is seen as a way to complement traditional in-house innovation efforts, right? It's faster, it's less costly, more likely to come up with out-of-the-box disruptive ideas. So a lot of good reasons, and that is ultimately playing, offense as much as defense, right? So offense in the sense that can we come up with something new that will be, ultimately we can bring in-house so that we can partner with and will add a lot of growth to my existing business or one of them. But also defense in the sense that how can I protect against, right? If I'm, I don't know, right? And Microsoft and Apple suddenly comes up with mobile and owns that, or, there are many obviously good examples of large, powerful corporates that were disrupted by somebody else. And so the defensive aspect is, let me try and, pursue some of this myself so that I have my pulse on the market and I know what's happening. And I'm not going to be blindsided by somebody coming up with something hugely disruptive to me. So that's I guess the theory. The reality is that a lot of corporate venture capital initiatives have seen mixed success, right? So, and I come back to, the question that was asked earlier on the strategic benefits. I think generally these are seen as limited or often limited, and the financial results are, I'd say mediocre, right? And now the challenge here is even on the financial results, there's not much data because people usually don't disclose these. And the strategic benefits, as we said, are very hard to quantify, right? But I think what's clear is that, corporate venture capital is underperforming mainstream venture capital, a non-corporate venture capital, which in itself as an asset class doesn't have stellar returns. There are obviously notable exceptions, but as an asset class overall, it's a very, it's not a great, returns are not great, right? So if you put that together, that means that corporate venture initiatives are often short-lived. And I've put the less than 5 years here. I've seen different figures. I saw one as low as 3 to 4 years. So the average, so even considering the Google ventures and the Intel ventures and people who've been around for decades, I guess in the case of Intel, not Google, even if you count them against an overall average, you still have a very short lifetime of these initiatives. So, and that's, I guess, is testament to the limited success that these initiatives have had. And on the right here, I'm listing some suggestions as to why that is. And a lot of these, when you read through them, a lot of these are obvious, right? So yes, VC is full of failures and corporates have lower tolerance for failure, and it's obvious. Time horizons are shorter. There's, stock market reporting requirements. There's sort of managerial careers and so on. So the patience is more limited. Sometimes, there's the wrong people in these jobs in corporates, i.e. people without VC experience or limited experience. That can be an obstacle. Poor governance, where there's limited independence and more meddling from the corporate for pet projects, and then ultimately insufficient engagement and support from the corporate for the investments that these corporate VC arm makes, right? So you read through all of these and they all sound intuitive, and therefore you think it's easy to, or it should be easy to address them and to fix them. But I would argue that that's where the challenge is. So they're easy to identify, I believe, but from a corporate point of view, very hard to fix.
Is there a cultural fit clash between most of corporate and VC startups? Are certain corporates, I guess, are best equipped than others based on their culture?
I think so. I think that, well, it's sort of a spectrum, right? So you might have, as all of you know, probably from your own professional experiences, you have larger organizations that put a lot of effort into trying to maintain a more nimble and entrepreneurial culture, and some of them are quite good at it, and others don't. So, if you look across that spectrum, obviously the former group, the first group, that manages to maintain some of that entrepreneurial spirit even in a large organization, will be better equipped for this, right? But if you put it, side by side, presumably even, and I would imagine that even large, call it tech companies, will be very different environments from, and will have very different cultures from the companies that their venture arms might invest in, right? So I think it's a question of degrees. I think the observation is right, but it's a question of degree of, how big is the gap basically in culture. I come back to the key success factors here, and they obviously link into the observations as to the issues and the obstacles, and they highlight perhaps why this is so hard to do. So long-term commitment, right? Typically what happens is, and I mentioned the cyclicality in the overall market volumes and number of investments. So typically what happens is markets are rising, everybody's looking left and right, there's a lot of technology, a lot of disruption, a lot of growth. And corporate senior executives say, okay, we need a piece of that, and we need to turbocharge our innovation, etc. Let's set up this initiative, a fund, let's commit some money, hire some people or shift some people. They start investing, and at some point, 2, 3, 4 years later, the environment turns, and there are losses in the portfolio. There's not really anything yet that has made money, and the corporate is forced to retrench elsewhere and cut costs, and the environment is not great. Maybe there's new management somewhere that comes into the corporate and says, oh, what is this that my predecessors have been doing here? And then these corporate venture initiatives are often either cut back or shut down, or changed in meaningful ways, right? So pushing back against that and having long-term commitment is very important. The traditional VC investors have that. And it's a way to sort of beat the famous J curve, right? Where for these types of companies, you would expect all of them to go through a number of years of perhaps negative development, certainly in terms of cash flow and profits, and maybe even pre-revenue, before, if they are successful, before at some point after perhaps 7, 8 years, they turn a corner. So that's foreign to the corporate world and the short-termist nature of the corporate world, but I think is key for success if a corporate wants to play in venture capital. The numbers game here and the failure rates is also interesting, right? So if you think about corporate investments, similar to even when you do M&A, but also organic investments and private equity is the same. It's more about, yes, you want to make money, but it's more about not losing money, right? You don't need a blowout success. You'll take it if you get it. But it's okay if it makes, I don't know, if it beats your hurdle rate, right? In a corporate, I don't know, 10, 12% cost of capital, you're happy if it exceeds that, right? In an investment project or an acquisition. VC and early stage investing is very different, right? You don't care about the failures. And there's some big quotes out there from famous venture capital investors. So if you make 10, 100 investments, you'd expect a lot of them to fail and to lose your shirt on them, or to lose your entire capital on them. What you focus on is, do I have 1 or 2 or 3 big winners in that portfolio of investments? And that mindset is very different, obviously, from the corporate mindset, right? So again, here, a significant cultural gap. And playing the numbers game means you have to have a significant number of investments to sort of overcome the law of high failure rates, right? So if you just make 5 or 10, 15, it's unlikely that you'll have a big enough success from a financial point of view to beat, the money that you lose on all the others. Hiring experienced people is obvious. I think there's a tendency still in corporates to have, an ex-banker, an ex-consultant, somebody who's come up through the corporate, and they're all highly capable and professional people, but you can't replace, I think, in this market experience of people who've actually done it. And so if you don't have it in the organization, I think you have to go abroad and hire that and pay up for it. Another obstacle. Governance is obvious, right? You can't meddle too much from the corporate side. Once you've set it up, you have to let these people run. Aligning investment themes is, I think, among the easier ones to get right on this list, right? What that means is you don't want to run, you have to give an initiative like that a mandate to be aligned with what you do as a corporate, for it not to sort of develop its own life and chase opportunities that might be promising for other reasons, but where the best you can hope for is a good financial return, as opposed to something that really strategically helps you as a corporate. And then the last one here is, I think, very significant and not easy to do as well, is how do you, once you've made investment through a corporate venture initiative, how do you actually use your, if you think about what your competitive advantage is against traditional VC investors, it is that you bring a lot of resources that you have in your company, capable people that have customer access, market knowledge, knowledge of other technologies, traditional technologies, maybe around what this company does. And so for you to leverage that competitive advantage, you have to bring that to bear, right? You have to link the companies you invest in some form to what you have. And so, so far so obvious that the challenge with that is often you have, obstacles in trying to achieve that, right? You have people inside the corporate who don't have the right mindset. There's often inertia and sometimes even, counterproductive behavior, which I've labeled antibodies here, where people, see a company like that, the corporate has invested in through a venture capital arm as a threat to their existing business and therefore limit their cooperation. So none of these, I think, are earth-shattering, but based on what I've seen, getting these right is, for a lot of them, is very, very difficult. And getting them right over time, not just at the outset, but sort of staying the course and for 5, 7, maybe 10 years, I think is very hard. Okay, so just briefly on Schneider and what we've been doing in corporate venture. And this page is just an overview of Schneider overall for those that are not very familiar with it. So Schneider is a big company, originally French, headquartered, today very global, with sort of 3 big hubs outside Paris, in Boston, and in Hong Kong. 26 billion euro revenues. I picked out the R&D spend here. So that's, a billion, close to 1.5 billion euros. So every year is spent on R&D. And a lot of people, close to 140,000 employees. In terms of what Schneider Electric does is, listed the end markets here, not a detailed business description, but Schneider is, a leader in electrical products, low voltage electrical products and systems, some medium voltage products. So circuit breakers, switches, a lot of the electrical infrastructure products that go into buildings and data centers. That's where Schneider plays. It also has a significant presence in the industrial manufacturing world through industrial automation systems and increasingly industrial software as well. So that's another mainstay of the group. So that's sort of the backdrop of who Schneider is. And I think there's a sense inside the company that, our markets are, in large parts of our markets are ripe for disruption. And so there's significant thinking and money and effort and resources spent on, not just since yesterday, since trying to position the company to benefit from that disruption, as opposed to, being disrupted and being made less relevant or irrelevant. So, this is sort of the Schneider Electric backdrop. Now, what have we done in terms of CVC at Schneider? And what I've put here in writing is sort of somewhat summarized, because obviously not all of that is for public, or not all of what we've done is for public consumption, but what is here is, is public, and we've talked about this at various conferences. So Schneider has, played in this market before with mixed success. Mixed is probably an overstatement here, so with not great success. There have been sort of direct venture initiatives owned by Schneider. There's more recently been, so this is a few years back now, there's also been, which was then stopped because it didn't do well. More recently, the last few years, there's been an association with and an investment in a fund that was a separate external fund, into which various other French large corporates also invested. And that kind of went on for a number of years, but ultimately I think from Schneider's perspective didn't, have good results. So we stopped that a year and a half ago, and we've started restarted a fully owned in-house venture capital fund or initiative called SE Ventures. It's officially launched this year, but obviously the preparation goes back a little bit longer. It's part of a broader innovation strategy that we have at a corporate level that sort of goes under the slogan "innovation at the edge," right? And the idea behind that is, how can we harness? So, we're probably not getting, like most big corporates, we're not getting enough results out of the 1.5 or 1.3 billion euros we spend in R&D every year. How can we improve that? So there's the internal. So what's what at the edge, right? There's internal traditional innovation efforts through R&D. External would be, what other people do and that you try to, potentially buy or partner with. And then at the edge is this concept of, let's try and make this gap between internal and external, if not disappear, but substantially, let's try and shrink it substantially, right? So let's have a coordinated effort between what we do internally, what we let others do, what we invest in, what we might incubate. And so let's try and have a consistent strategy that covers all of those potential options, and let's try and manage innovation across that spectrum. As it relates to SE Ventures, they sort of say, or they organize themselves in what they call 3 practices. One is incubation, then venture investments and partnership. Incubation is what it says, right? So it's helping people inside Schneider that have great ideas and want to pursue them externally, helping them do that. It's also helping entrepreneurs outside in the very early stages. Venture investments is what we've mostly talked about here. So where there's actually, a company up and running and, where we take active, where we make direct investments. And then partnerships is a little bit of all of the above. So partnering with some of the companies we invest in, partnering with the companies that we incubate or the ideas that we incubate, but also partnering with other people, existing companies or ventures that have some sort of relevance to our strategy. The areas of focus are, in line, as you would expect, with what Schneider does. In terms of the scope of this effort, they're targeting, I don't know why the odd number 12, but sort of call it 5 to 10 plus investments per year on the venture side, which, you can sort of extrapolate that. It's probably, on average might be 100 million or so per year over the early years of the fund. So several hundred million in principle committed to this. And then the incubation projects, that they're aiming at 3 to 5 successful ones. That obviously doesn't take that much investment. It's more about support here. They're deliberately agnostic in terms of size. They have a preference for later stage investing, or at least not very early stage investing. So sort of from Series C onwards, not Series A or B, because the view is that that's where the earlier you go as a corporate, the harder it becomes for you to be successful. And then to address another one of the challenges that I referenced earlier, often the lack of support from the corporate for the companies that the CVC invests in. There's a dedicated partnership team of, I think, half a dozen people sitting inside Schneider Venture or SE Ventures whose only job is to basically foster links between portfolio companies and the relevant startups on the one hand with what Schneider does, right? Linking them to the right people in a big organization and proactively thinking about how we could support these companies and initiatives. Today, the group, the SE Ventures group is relatively small. I think that'll grow a bit still in the coming months. And they've already made in their relatively short life or short existence, they've made 11 direct investments already. So, I think there are a number of elements here that try to address what I've discussed and what we've identified as some of the pitfalls in corporate venture investing. But by no means does that guarantee that this is going to be successful, right? So it's relatively new, and we won't really know until in at least, I would say, 6-7 years time. Perhaps one last comment here before we open it for further questions. And coming back on one of the earlier questions on how do you measure the non-financial success, I think you can try and that's I think what we're trying to do here is, right, they have some metrics, and I haven't put them on the page, but they have some metrics in the partnership team as well as in the broader SE Ventures team as to basically some KPIs, right? So how many interactions has this portfolio company had with in the past 12 months, right, with the rest of Schneider? What has any of their initiatives, has their business plan, their product development been accelerated, because of Schneider, right? So and that's in the earlier stages, and then later on, obviously, which of these are successful in a way that we actually in the end want to own the technology. So they have a number of KPIs in that sense, but all of those are imperfect, right? They're not as easy as financial KPIs for sure. So I'll stop here, and Melissa, I don't know if there are further questions on the chat.
Yes, we do. We have one. It's how detailed is the coordination between the corporate and the invested startup? On one side, limit interference. On the other, provide resources and expertise.
Yeah, that's a good one. I think the interference comes in when, well, I think the first risk of interference is at the investment stage, right? And we've had some of this. So you have some senior executive running a business or a division within the company, and they like a technology, they like a certain business, they'd like to pursue it. But they see it's money losing today. It's early days, so they don't they don't pursue it as a corporate M&A, corporate acquisition. But then they know that we have this venture initiative, so then they sort of try and push it there and say, you guys should invest in this, right? And for them, for a corporate executive, or for a business, there's no cost, right? It's not your capital that gets invested. There may be a little bit of sort of reputational cost if it goes horribly wrong, but other than that, it's not your money, right? So you could argue it's a little bit of a one-way bet, and that interference is not healthy, right? So once you've set something like this up and you've defined the criteria in terms of the areas where this CVC should invest, I think you need to let the professionals do the job and make their judgment as to what they should be investing in. Right? The interference at a later stage, once the CVC has made investments, I think comes down to, I think there is a risk in that if it's something hugely disruptive, the risk is sort of it's perhaps less interference, but rather what I labeled antibodies earlier, right? Where if somebody within the company that is being linked to this technology is potentially disruptive to their own business or their own job, maybe even, you could see how they might not welcome that with open arms. And I think that is hard to regulate. This initiative here with the partnership team, I think, is there to try and overcome that. If you run into issues where a partnership team or a body like that can't resolve it, then you have to escalate it within an organization, right? You have to get somebody senior who's supportive of this as a concept, tell people in the business that they need to cooperate.
Okay, we have another question. If you compare CVC and M&A, to what extent do you think the management attention is healthily shared between both activities at Schneider?
I think at Schneider, yeah, good question. I think at Schneider, perhaps the way to look at it is if you look at it over the last, 5 to 10 years, and you would take the overall time that senior management would have spent, our CEO and CFO would have spent between the two, then that balance would be heavily tilted towards M&A. Schneider has been very acquisitive, done a bit of divestitures, but mostly it's been very acquisitive, and so senior management has spent a significant amount of time on that. And I'm just judging by the last 15 months that I've been here, and much less time on CVC. I think with this new initiative, if you just looked at the last 12 months or so, I think that balance would have shifted a bit. It would still be more tilted towards M&A, but I think it would have shifted a bit. There's been quite a lot of senior management, so executive committee level engagement and discussions about setting this up, how to size it, how to structure it, and a lot of the questions that you need to decide. So they've spent a fair amount of time over the last 12 months, 18 months probably, on the setup, I guess, of this. Once it's up and running, I think it becomes a little bit less labor intensive again for senior executives, right? They get their updates, they may get involved in specific situations, but otherwise it's a little bit more detached, I would argue, and probably for good reason. So I think if you were looking for, that was not your question, but I think if you were trying to figure out what the right balance is, and I'm not going to put a number on it, but I think you would want senior executives to spend a little bit more time on M&A just because the bets are greater, right? Now, you want senior management to be involved sufficiently in CVC initiatives to make sure that from a innovation and disruption perspective, you're not missing something. So that's bigger picture, I think, than you have the CEO or CFO involved in looking at a sizable acquisition target and making judgments on that. Very good question.
Okay, we have another question from AF. If CVC means buying minority stakes with strategic goals, I would expect that several CVC companies from the same field would end up investing in the same target. If the target is successful, I would then expect a competition amongst the investors to acquire and control the target's technology. Is there any evidence in favor or against this?
I think there's a bit of evidence against this, and I wouldn't say it never happens. I don't have real data, right, to give you a precise answer. But typically, when the anecdotally, what you see is when you look at some of these early stage companies and you look at who owns them, then you get your typical venture investors, and where you have corporate venture investors in them, they do sometimes invest alongside each other, but typically you will see corporate, if there are several CVC investors, you will see them from different markets or different areas, right? So especially in the energy world, I think somebody referenced that in a question earlier, and that's obviously very relevant for us. You might have somebody like us who is more of an equipment solution software player. You might have a utility, you might have maybe a separate software company, right? So when people think about, and why is that? It's because for the reason that you mentioned, right? The potential conflict that you might face if we invest alongside one of our big competitors, say Siemens or ABB or people in the US. But it's also that I think when corporates, when smaller companies try to figure out who to choose as their investors, if they have the luxury of doing that, then they will look to have complementary investors, right? They want to bring in people who care and will have a stake not only financially but also beyond that strategically. And so they look, and just as you would look to build a management team with different skill sets, I think you try to replicate that at the investor level, right? So then you have some traditional VCs, and then you have some CVCs who bring different perspectives and different experiences. And therefore, I think you see, for both of those reasons, I think you see that less. I don't think it's, I have seen it before, but I think it's less common to have direct competitors invest in the same, from a CVC perspective, in the same early stage company.
Okay, we have quite a few questions for you, actually. Did Schneider Electric CVC have any experience in competing with a VC to close a deal? And do you have any learning from this process?
Sorry, Melissa, I missed the middle part. Did
Schneider Electric CVC have any experience in competing with a VC to close a deal? And do you have any learning that you would like to share from this process?
And I have to, that's where sort of I'm less in the day-to-day, but I'm broadly speaking, for sure, right? I mean, this is certainly in today's world, right? Capital is a bit of a commodity.
to overstate the point a bit. So, interesting companies can choose their investors, and therefore you are, as a CVC investor, you face significant competition in many cases. And that can be other CVCs, but if you look at the breakdown of the market, right, and the stats that we had at the outset, if more than 3/4 of the market by number of deals, I think it was, is VC, then they clearly dominate the market, right? So I'm pretty sure that we bump into this all the time. But then, as you know, you have like most companies at this stage of their development have several investors. So we would, I think, typically come in with our investment focus that I described earlier, that we try to avoid the very early stage, the seed type of situations. If we come in a sort of Series C or Series D, then you would have existing investors already, with whom you don't compete, right? But there will be other people interested in coming in at that point with whom you will be competing. And lessons learned. I don't know if there's specific lessons learned from those situations. When I talk to our team in the who runs this initiative, they always, point to the fact that I don't think they have as a corporate venture investor, it's typically not the expertise or market knowledge or resources or so on where you are, where you are challenged. It's typically the mindset and the speed, right, and the tolerance for failure and losses, where I think the traditional VCs probably have a leg up, right? Even if the people in that team that we have come out of the VC world, and I know that's the same for some other CVC programs, but you still have to, right? The environment changes, and it's not easy to keep the same mindset that you would have in a traditional VC. So I think that's in terms of how we compete and lessons learned. I think how do you retain the traditional VC mindset and flight speed, even if you're part of a corporate of a CVC initiative.
Okay, great. We also have a question: CVC versus entrepreneurship. Start from scratch from within a corporate. What's your view? Is anyone better than the other? Are they comparable? From a corporate perspective, it's better to develop something from within, from scratch, or rather invest in something external? Yeah,
I think that, and that's sort of in the day-to-day, right? For the people who manage innovation, that's the million-dollar question, right? And that's what you outside of innovation, what you would have in terms of make versus buy. And I think there's no general answer to that question. You have to make that judgment in every case, right? And the criteria I think that people will be using are, where is it most likely going to succeed? How long is one and the other going to take? How important is it for me, if it does succeed, how important is it for me to own it in the future, right? Do I need it in-house? Absolutely. Or will it be somehow open and I'm happy for it to be owned by somebody else as long as I have access to it and, have a relationship, maybe a strategic relationship with it. And that will vary, and this is just naming a few. There's certainly lots of others. But I think it's those criteria that you have to run through to make a judgment in each case. And the answer will be different in each case, which is why even companies that have, big CVC initiatives obviously continue to innovate internally as well.
I wanted to thank you for your time today, Axel. It's been great. Lots of good insights, and we appreciate your time and giving back to the CEMS community. So thank you again.
Very good. Thank you, Melissa. Thank you for hosting me, and thank you all for joining. I'm sure you all have busy days and probably had to trade this for lunch or eat your lunch during this. So thank you for joining.